Here is the average net worth by age. I'm going to give you a second to just have a little brief look at that. Now, if you're sitting under the average, you're probably sitting there thinking, oh, bloody hell, I'm behind, I'm failing. But here's the thing with this chart. It is measuring the absolute wrong thing entirely. You see, most people use these averages as like a scorecard, right? If you're above the number for your age, you're winning. If you're below it, you're falling behind. But what if I told you that someone with £500,000 net worth could be far better off and in a better position than someone with £2 million net worth? So today, I'm going to show you why net worth, particularly comparison net worth by age, is a rubbish metric, what you should be focusing on instead, and 3 concrete ways to build real wealth that actually gives you options. We're talking potentially like 6 figures extra of wealth in the next 20 odd years just from these changes. So let's get into it. Before we get into thinking why these charts are potentially misleading, let's just make sure we're actually talking about the same thing. So net worth is literally just add up everything you own, so property, pension, savings, that fancy watch collection that you might have, then subtract everything you own, so mortgage, loans, credit cards, all that sort of stuff. That is your net worth number. So when we look into this data, now let's have a little look at it. So it starts low, right? 16 to 24, you're looking at 5,200. 25 to 34, it jumps to 109,800. That's about when most people start buying their first home. By your 40s, it's well over 200,000. And the peak is 65 to 74 with 502,500. Compare that to 16 to 24 year olds at 15,200. That is 33 times higher. Now, obviously, after 75, it drops off to 373,100 as people actually start to use their wealth. Now, drop a comment below. Are you actually above or below that median age? No judgment here. I'm just curious to see kind of where everyone's at. I'll reply to as many people as I can. Now, listen, there is a massive problem with these numbers. They lump everything together without telling you what it actually matters. Let me explain. So there's basically 2 types of assets. There are productive assets and non-productive assets. And the difference between the two is absolutely everything. So non-productive assets, that's things like the main residence that you live in, your home, your car, your jewelry, your furniture, all that other stuff. Now, they might go up in value, sure. Your house could go from £500,000 to £5 million. But unless you sell it or like rent it out, that doesn't actually change your standard of living one bit. You're just sitting in a more expensive property. You can't pay the bills with it. You can't generate a passive income from it. It is trapped wealth. Productive assets, on the other hand, that's things like investments, investment ISAs, pensions, general investment accounts, any property that you can actually rent out that you have. This is wealth that generates passive income, wealth that you can draw on, wealth that gives you options. And here's what kills me. These statistics, these average net worth figures, they treat them exactly the same. A pound locked in your house equity counts exactly the same as the pound in an investment ISA, an investment account. That makes absolutely no sense. So I just try to distinguish between the two. By the way, if you want more insights like this every single week, I've got a free email that I send out, tactical wealth building strategies that I've learned over 15 years of helping clients, stuff that you don't often find in these videos, links in the description if you want to join. Now, let me show you why all of this actually matters. Let's look at 2 people, right? Let's call them Tom and Sarah. So Sarah has a house worth £500,000 and a mortgage of £200,000. So that leaves her with equity value as an asset of £300,000 in home equity. She also has £50,000 in an investment ISA. Total net worth, £350,000. That looks brilliant on paper, right? Let's look at Tom. Tom, he has £100,000 in home equity because he owns a home that's worth £400,000, but he's got a £300,000 mortgage. But he has £200,000 in his ISA. So his net worth is only £300,000. So according to this, Sarah is winning by 50 grand, right? Wrong. Sarah has only got £50,000 in what I would call productive assets, money that she can actually use to generate a passive income. Tom has got £200,000 in productive assets. That's more than 4 times as much. So think about it. What happens when Sarah's company, I don't know, does redundancies, or she loses her job? She's got maybe a year runway if she's careful, but she's stressed and she's scrabbling around for the job. Tom, well, he's got 4 years. He can be selective. He can retrain. He can do whatever he wants. Now, these two people have virtually the same net worth on paper, but completely different lives. And that is the polar difference that we're talking about today. So here's the question. Are you building Sarah's wealth or Tom's wealth? Most people don't even know which one they're building. Well, here is how you become Tom. What should you actually focus on? Well, obviously, your productive assets, right? I call it liquid net worth, the money that you can actually use, again, to generate a passive income. This is things like your ISAs, your pensions, your investments accounts, your rental properties, anything that you can generate income with. Now, also, I know what you're thinking about pensions, but I'm locked in until I'm 55. It's soon to be 57, but whatever. Fair point. I still view that as a productive asset because yes, you're locked into a certain degree, but it's invested and you're actually able to draw an income from it when that time comes. Compare that, for example, to your home equity, which might be double or triple in value. But unless you're renting it out or you're renting out rooms or you sell up and release equity, it's not generating anything. Here's why productive assets matter way more. If you've got £200,000 in an investment ISA, you could take sustainable income from that, or collect dividends, or let it grow and just know that you have access when you need it. This is the number that determines your actual financial freedom, not just your total net worth, your productive wealth, because that is what lets you take a career break without panic. That's what lets you say no to a job you hate. That's what means that an unexpected car repair doesn't wipe you out. It lets you retire when you want, not when you're forced to. And that is what matters the absolute most. Options. So instead of asking, what is my net worth by age? Start asking yourself, how much productive wealth do I have? How much I can use to generate a passive income? That's the question that matters. Right, so now you understand the framework. Let's get practical. I'm going to show you 3 ways to build more productive wealth faster. These are specific tactics that I've helped to use my clients build 6 figures worth of wealth, okay? Strategy number 1. And honestly, if you're not doing this, you are leaving massive money on the table. Salary sacrifice with employer matching. This is the biggest leverage that you've got to keep more of what you earn and turn it into productive wealth. Now, here's how it actually works. Let's say that you earn 100 quid. If you're a higher rate taxpayer paying 40% tax, something like that, only £60 of what you've earned is going to land into your bank account, roughly. That's 40 quid gone in tax and national insurance and things like that. Broad figures, but you get the point. But with salary sacrifice, that same £100 goes straight into your pension before tax even touches it. So the full 100 quid goes in. But here's where it gets wild. Most employers will match your contribution pound for pound up to a certain limit. So that £100 that you put in, They put in another 100. That's 200 quid into your pension. Now, compare that to the 60 quid that you would have had in your bank account, that if you just taken it as salary. You've gone from £60 to £200. That's more than triple your money on your earned income instantly. Millions and millions of people in this country do not contribute enough to get their full employer match, and they are leaving millions, thousands, millions on the table each year. This is one of the biggest financial leverages that most people have access to, and they don't even use it properly. I had this client once who was earning like decent money, high rate taxpayer, just wasn't contributing to his pension at all. And he just wasn't paying attention to it, right? He just was cracking on with his job. I understand that. And one day I showed him the numbers and he was so gutted. He had been leaving thousands of pounds on the table every year, thousands, just sitting there waiting for him to claim. So, action step here. Check your workplace pension scheme, find out the maximum employer match and contribute at least enough to get all of it, because every pound you don't contribute is money that you're just handing back to the tax man while your employer match just sits there unclaimed. It's the closest thing to a financial cheat code you will ever find. Now, yeah, it's locked in until 55, soon to be 57, but when your money just tripled instantly, who cares if he can't touch it for a while? I'd actually argue that it's a real benefit as well. That is wealth building on bloody steroids, right? Now, that is the fastest way to build productive wealth, in my opinion. But here's the thing. If you've got something like high interest debt, it's like trying to fill a bucket with a hole in, which brings me to strategy number 2. Pay off your high interest debt. And I mean properly pay it off, right? Don't just make the minimum repayments. High interest debt is like investing in reverse. It's destroying your ability to build productive wealth. Credit cards at 20% APR, personal loans at 10, 15%, that is wealth destruction happening in real time. Think about it this way. If you're paying 25% interest on a £5,000 credit card debt, that's 1,250 quid a year going straight to the bank rather than you using it to build productive assets. Meanwhile, your ISA might be earning like 7%. You are losing 18% on that money every single year. It's painful when you actually see it like that. So here's the top priority, right? Pay off your high interest debt before you start investing properly beyond your emergency fund and all that sort of stuff. Paying off 25% debt is a guaranteed 25% return. You can't beat that in the stock market. It's the best investment you are ever going to make. So list all of your debts, list them down by interest rate, essentially. Make sure you're paying the minimum on everything, and then throw every extra pound at the one with the highest interest rate. It's what's called the avalanche method. It works every time. It's not always the best psychologically, because sometimes you might want to tackle those smaller debts first, but it's the most mathematical, superior option. Now, one exception here, just remember, like we said, still make sure you get your employer match with your pension first, because that's free money that we're talking about, right? But after you've done that, smash your high interest debt. Then focus on building productive assets. That's the order. Every pound of high interest debt you clear is a pound freed up for actual wealth building. All right, so here's what happens next for most people. They get their finance sorted, their debt's gone, they've got money coming in, and then they just park it in a savings account, leaving it there for absolutely years. And that is a massive mistake. The third strategy, stop saving in cash beyond your emergency fund and your short-term needs and start investing. Right now, cash savings accounts are giving you 4-5% if you're super lucky. And, or more often than not, if it's outside of an ISA, you're actually paying that tax on interest unless it's under your personal savings allowance. Meanwhile, inflation is still elevated, right? 3-4% still. Your money is barely keeping pace or actually losing value in real terms. Compare that to, a stocks and shares ISA, tax-free growth, tax-free income, and historically 7 to 10% average returns from the long-term growth of the stock market. Now, you might be thinking, but yeah, okay, but cash is safe, right? Well, in my opinion, wrong. You know what's not safe? Watching your money lose value year after year while you think you're being sensible. That is not safe. That is just slow destruction. So let me show you what this looks like. Say you've got 10 grand sitting there for 20 years in a savings account earning 5%, you'll end up with about 26.5 grand. In an ISA at 8% invested well, 46,000. Now, of course, it's not that simple. There are some risks that you take to get that extra percent of return, but that is an extra £20,000 just from moving money from a cash account into investing, all tax-free if it's in an ISA. 20 grand, well, it's a part of a house deposit, right? It's a year's salary for some people. 2 years of not worrying about money in retirement. That is what this decision is actually costing you. Now, caveat time, obviously try to keep 3 to 6 months worth of expenses in cash as your emergency fund. That is a kind of non-negotiable, to be honest with you. You need that safety net. But beyond anything beyond that, turn it into a productive asset. Don't invest money you need within the next 5 years because markets go up and down, right? But for long-term wealth building, productive assets beat non-productive assets every single time. So action steps here. Open a stocks and shares ISA if you haven't already. Use your annual 20 grand allowance and start investing in low-cost index funds or in a managed investment solution in line with your attitude towards risk, okay? Set up monthly contributions so it's automatic. Don't think about it, just let it happen. Now, I've actually made a whole video breaking down exactly how to figure out if you've got too much cash and what to do about it. It's called the 3-step formula to remove the wealth breaks. And honestly, this is the bit that trips most people up that I work with. So watch this video here next, because everything we just talked about really won't work properly if you're still hoarding cash unnecessarily. So give it a click and I'll see you there.